Look, you get your paycheck, pay your bills, and proudly transfer a few $100 into a savings account. 6 months later, the balance hasn't moved, but your groceries cost way more. Not pleasant? That's exactly what happens when you mistake saving for wealth building. My name is B. By creating this channel, we wanted to give vent to our curiosity by analyzing books, analyzing thought processes, and trying to understand finances just to be greater. By creating this channel, we are consolidating our knowledge on many issues important to us and breaking the problem down into its constituent parts. Just a quick reminder before we dive into the math, this video is for educational purposes only and is not financial advice in the legal sense. Always do your own research. Here's the thing. Biologically, hoarding cash lowers our anxiety. It feels safe, but here's what most people don't realize. Playing it completely safe with your money is mathematically the most dangerous thing you can do. Perhaps the only thing worse would be keeping money under the mattress. To prove it, let's run an experiment. We are going to take exactly $10,000 and see what happens when we put it into different financial vehicles. Let's start with the baseline, savings accounts. Say you put that $10,000 in a savings account earning a generous 2%. You make $200 in a year. Great, right? No. If inflation is sitting at 4%, your purchasing power just dropped. Your safe money is bleeding value. You need a savings account for a 3 to 6 month emergency fund, but after that, a bank account is a parking lot, not a highway. To build wealth, your portfolio needs an engine and shock absorbers. Let's look at the shock absorbers. Bonds. When you buy a treasury or corporate bond, you become the bank. Treasury bonds give you an opportunity to lend money to some country. Logically, the risk is low. It is hard to collapse the whole economy of the country. Of course, it depends on which one you pick. Corporate bonds work the same, but risk is higher. The probability of the company going bankrupt is higher. You lend money, and they pay you interest. If you buy a $10,000 corporate bond paying 4%, you get $400 a year passively, plus your $10,000 back at the end. Bonds are predictable. Psychologically, they stop you from panic selling when the stock market crashes. But this is where it gets really interesting. We have shock absorbers. Now, we need our engine. Stocks, specifically growth and dividend stocks. For simplicity's sake, dividend stocks are massive mature companies like Coca-Cola. They make so much profit they hand you a chunk of it every quarter. If you put $10,000 into a 2.5% yielding dividend portfolio, you get $250 a year in cold cash. Seeing that cash hit your account is a massive psychological dopamine hit that keeps you invested. Growth stocks are mostly tech innovators. They don't pay dividends. They reinvest profits to build empires. If you invest that same $10,000 into an S&P 500 growth fund and just leave it alone, assuming a historical 15% average annual return, less than historical data, after 10 years, without you adding another dime, turns into over $35,000. It tests your patience, but it's the greatest wealth engine humanity ever created. B. Buying individual stocks sounds exhausting. What if I pick the wrong company and it goes bankrupt? You don't actually have to pick individual stocks at all. Enter ETFs, or exchange-traded funds. Think of buying a single stock like planting one specific apple tree. If that tree gets a disease, you lose your entire harvest. But an ETF is like buying a massive prepackaged basket that contains a tiny piece of the entire fruit orchard. When you buy one share of an S&P 500 ETF, you are instantly buying a microscopic fraction of the 500 largest companies in America. Apple, Microsoft, Amazon, all of them, in one click. If one company fails, it barely matters because the other 499 are holding you up. ETFs give you instant diversification. They take the intense risk and stressful guesswork out of the equation. You get to own the growth of the entire economy without having to manage a thing. Just buy, hold, and let compounding do the rest. Obviously, there are a lot of types of ETFs. However, we will discuss them on another occasion. You build a machine. Got $500 a month to invest moving forward? Here is the math. Fill your emergency savings first. Put $50 into bonds for stability. Put $150 into dividend stocks for immediate cash flow. Put $300 into growth stocks for long-term compounding. Or simply buy ETF for whole market. Don't be the person who loses 25% of their purchasing power to inflation by hiding in cash. Be the architect of your own wealth. Low risk investment is easier than most people think. Let me know if I should discuss something more specifically, and remember to keep trying to be greater.